Hello, everyone. Welcome to this episode of Bondcast, the podcast series where we discuss the biggest themes and events shaping rates markets. I'm John Briggs, standing in for Imogen Bakra. And in this episode, I'm joined by Giles Gale, our head of European rate strategy, and Jan Nevruzi, our U.S. rate strategist. All right. Before I start, I do want to say our thoughts and prayers go out to anybody impacted by the conflict in Ukraine, colleagues, anyone listening, friends, and those of you who have friends and family that are impacted. Please know our thoughts are with you. It's a difficult time, and I want to make sure that we're all cognizant as we look at financial markets to talk about impacts on asset prices, that there is a human cost to this conflict. So our thoughts are with everyone. With that, it's kind of hard to know where to start on this, the events of the last week and the impact on markets. Thankfully, we just zoning in on bond markets here. I'm going to throw the first one to Giles. Sorry, I'm putting you right on the hot seat. We've had some of the most volatile moves in a long time this past week. What are your thoughts? How do you think about the market in light of what's going on and in light of the volatility?
Yeah, it's been really quite, in fact, exceptional. I did a little check back to see the last time we really had anything like it. And, obviously in some peripheral markets, there have been a few episodes over the years, but in gilts and bunds, you really, gilts in particular, you have to go back maybe 30 years to see this sort of volatility. So we're talking about really, really off the charts, exceptional moves. And so I'm mainly talking about Monday and Tuesday, when we had a very, very big fall in yields. And then, of course, since then, we've given almost all of it back. So, it seemed like there was, we felt like there was a bearish consensus out there, which at the same time was likely to be progressively validated by central bank movement. And so we weren't all that concerned about that. Of course, I think what was happening was that people were rethinking what they thought central banks were likely to do, in particular the ECB, but not only the ECB. And so essentially, again, thinking back to what happened last year, where people got too short too early, and then it wasn't validated. It was just a pain trade, which really basically just continued for the whole of the rest of the year. I think that the bears all just ran for the hills, and so we got weeks of repricing all just come through in one day, and then presumably that was then enough to clean enough positions that when people discovered that there wasn't a follow through, we came back. Okay, fine. So where does that leave us? There are some oddities, as you would expect. I think the front end in the US is a little cheap compared to at least the direction of travel globally. That, of course, has a lot to do with Powell's testimony, which I'm sure that we'll get onto. And so I think that the market still sees the Fed to a certain degree kind of on track, and it's sort of just adjusted that path. But I'll let that discussion go to Jan in more detail. UK asset swaps have been so volatile that swaps actually look really very cheap now across markets, but gilts on the other hand look rich. Then there are other things, smattering of other things like long end France is clearly looking expensive now compared to other sort of semi-core peers. Spain is looking particularly cheap. Front end Italy has been expensive and remains expensive. But broadly, I would say, given the size of the moves that we're talking about, actually, overall, what is perhaps most striking is how sort of well behaved within the parameters of recent behavior it all was. Broadly speaking, betas, the kind of sensitivities that you would normally expect, were sort of respected. So maybe that's the main takeaway. And I'll just say finally, inflation linked has been doing very well, as you'd expect.
All right, so I want to dive into that volatility discussion a little bit more because in my experience, which is growing longer by the day, when you have these days or periods of time where you have what seems like, relatively idiosyncratic things turning to a systemic feel. I mean, we didn't have like, systemic, this wasn't 2020, this isn't global financial crisis, but, like you have these moves that are just exacerbated by things. Sometimes there's something else going on. I mean, in my mind, are these ripples from the SWIFT impact from sanctioning the Russian central bank? Or is there something about cash raising because companies aren't getting coupon payments from Russia that they thought? Or, are banks worried about lines of credit? I don't have the answer, but I do, sometimes wonder if there's kind of some other stuff going on. Now, I'm a little relieved that we haven't continued to see those kind of moves and it's not been exacerbated. And I'm actually comforted by some degree that some of these things have come back. But, from your perspective, do you think have you seen any signs of, like systemic distress or, stress in front ends or anything that people should be worried about that may not be as apparent as, just watching bonds?
So not at this stage, no. Now, it is something that people I know are focused on, and it goes quite a long way beyond just fears of a return, another Lehman kind of moment, to be honest with you. I mean, some questions that I don't really know how to answer, to be honest with you, but are certainly out there, revolve around things like, what risk of cyber attack, and if Russia were to succeed in a cyber attack against European banks, have you thought about that? Well, the answer is it sounds pretty disastrous. No, I haven't done an awful lot of work on that. Clearly, we don't see that yet either. I would say, most people's base case is probably that we don't see it. Nonetheless, it is obviously something that we should be should be thinking about and trying to figure out a framework for. Okay. When it comes to money markets, which I guess is really the crux of that question, SWIFT is not switched off for the named Russian banks until the 12th of March. And so at the moment, any impact that we see is really just fear of instability rather than reflecting probably actual instability at this stage. So that's also important to bear in mind. I do trust to a large extent that central banks with their surveillance in data sets are much better placed than they were 13 years ago to spot this kind of thing and to sort of to expect this the areas of pressure that might evolve. Again, certainly not my base case that this will cause problems, but it's worth just remembering that date. To date, and up until now, we've seen some reluctance, I think, or signs of reluctance at least, with clients to term out repo. So it seems like activity, at least in Europe, has been being kept short, and this fear of systemic kind of instability might be part of that. Repo has been richening again in Europe this week, and obviously you can see that as well in asset swaps. I mean, I think the central bank will have some. We'll be monitoring that closely. Not to say that they will necessarily come with a new facility or anything like that in the short term to do anything to deal with that particularly, but we did see today, for example, the German finance agency create some more of a particularly squeezed bond in order to have it available to repo into the market. So this is something which is being monitored at some level by those who have the power to do something about it. And finally, I'll just say, FX forwards kind of they seem okay. I mean, there was a knee-jerk widening, very significant knee-jerk widening, which has also since tightened back considerably.
Yeah, driven by that demand for dollars. But all right, so shifting gears a little bit, we do have the ECB next week. Blackouts started. What are you expecting there? I mean, obviously they're the closest to the conflict, but also the first monetary policy maker response officially beyond speeches that we'll see.
Yeah, so I think that really for the ECB, flexibility is the watchword. No, so much so that yesterday, although we were looking for maybe a little bit more guidance from the chief economist, Philip Lane, just before we went into this blackout. We're now in this blackout period. He really didn't say anything. It was, I think at this late stage, the upside for him in tying their hands in any way at all, just 1 week out, just wasn't there. So what are we expecting? We still expect the PEPP to end at the end of this month. So that announcement will be made once and for all. We are looking for them to suggest, rather than be more definitive, that they're open to the possibility of ending quantitative easing altogether this year. So recall in December, they set out a path for quantitative easing that was essentially tapering down successively to 20 billion euros per month from then more like sort of 90 billion, say, per month, and they were going to get there by October, and then it was just sort of projected at that basic level into I guess infinity in the future. Since then, markets have been expecting them to accelerate that taper timeline considerably. We don't think that they will be prescriptive about that. They'll leave the door open, and so we're looking for them to claw back some flexibility around the way that they talk about that, and in particular, not just to emphasize the pace at which they can reduce, but also a certain amount of symmetry, so that they can, so that we will expect that they are open to increasing again if they need to. So those are the two main points. Then just one minor point, I think, is, but nonetheless important, particularly in the front end. We think that they use this language in their forward guidance where they say, we will continue quantitative easing until shortly before we start to raise rates. And so that has led the market to understand that there's this tight link between when you say you'll end quantitative easing and when you'll actually start raising rates. And we think that they'll drop that so that we can increasingly believe that they can stop QE, but not necessarily in the short term then leading to a rate hike. So that lag between the end of QE and first rate hike being made longer, in a sense.
Yeah, and as you said, that gives some flexibility to things, especially in a dynamic situation we've got here. All right, thanks, Giles. Really appreciate that. I'm going to switch gears a little bit and bring in Jan Nevruzi. All right, so that's the ECB side of things. In the US, we did hear from Powell this week. Any main takeaways? And then perhaps just a general overview on how the dynamics in the market this week have changed our views, if at all.
So Powell gave, at the time of recording, we only have the first day of Powell's testimony in front of Congress. So he spoke to the House. And he was much more frank than we kind of expected him to be. He gave a lot of the Federal Reserve's thinking patterns outright. So he basically confirmed the 25 basis point rate hike for March, which is now pretty much in line with what market is pricing. And even we're debating within the team, and to us, it all seems like he's closer to being between no hike and 25 basis points as opposed to 25 basis points and 50, which is understandable given all the recent geopolitical developments. You would see, the growth worries taking precedence over the immediate term inflation worries. So that's one. Unless anything goes completely unexpected out of unpredictably, we will get a 25 basis point hike, and the hiking cycle will begin from March. Second, he touched upon the balance sheet normalization process. He kind of almost formalized their thinking around a little bit more about the modalities. So we have, in his view, the process takes about 3 years of balance sheet rundown. Of course, they could be a little bit more aggressive given the inflation pickup, but we highly doubt that they would use any active asset sales to reduce their balance sheet, which means that even with a high cap, say something like 60 billion in treasuries, 40 billion in mortgages, they would start reaching capacity issues early next year without active sales. There's just simply not enough mature securities rolling off the balance sheet to allow for a full 60 billion runoff every single month, except for the refunding months. But that being said, the takeaway for the balance sheet is it's going to take about 3 years. They're likely to start sometime after the first hikes. So our estimate is still for a May announcement and a June effective start, and then quickly ramp up to the 60 billion, our estimate of what they're going to allow monthly balance sheet runoff in treasuries, and then avoid any active sales and see how it goes. And they're going to gauge the level of reserves in the system, and they're going to dynamically try to see what the banking system needs, what are the optimal level of reserves, and let's stick to that. They're going to let the economy grow a little bit into the Fed's balance sheet as well, not just simply offload whatever they bought over the past couple of years. So those are the two main takeaways. He underscores the strength of the economy, the uncertainties around near times, and the persistence of inflation, and the Fed is going to start making moves.
All right, what about our views on the market? Obviously, huge volatility. 5-year yields fell 30 basis points over 2 days, giving a lot of that back. Maybe just on both just direction, but also on curve. Absolutely.
So looking a little bit more medium term, our views haven't really changed given the persistence of inflation, the strength on the underlying strength in the economy. However, in the very near term, given all the uncertainty around us, we have stopped out of our trades. So we had a view of higher front-end rates due to the repricing of terminal rate from the Fed. So our view was, we had positioned ourselves with short 2023 December SOFR contracts, October Fed funds, with the risk of the Fed stepping up with a larger hike later on in the year. We stopped out of those just because it is not the right time. It is not the right time to keep these on. The core view could be right, but given all the volatility, it's just untenable to hold on to these positions, even with a high conviction over the medium term. Similarly for the curve, we had 530s flatteners on. We still believe in the background of the trade. We still believe in the core of the trade fundamentally, but with volatility like that, it's just not realistic to expect that things cannot go 20, 30 basis points against us before going in our favor. So we will be actively monitoring to see if any further pressure in markets, both liquidity and in funding markets in general, show up, if we can get any better entry points. But just in general, with this level of uncertainty and with a tail for risk skewed that much to the downside, or at least like a distribution that allows for such a massive downside, I don't think it's the right time to be implementing a short fixed income ideas.
Yeah, I mean, it makes sense, especially because it seems like all signs against all my personal hope is that it feels like this is going to drag on rather than be solved anytime soon, either diplomatically or militarily. So I think there's going to be plenty of not just perhaps new opportunities to engage in these kind of trades, but also I think there's going to be plenty of volatility for all of us. So, all right. Well, thanks, Giles. Thanks, John. And thank you, everybody, for joining us for this episode of Bondcast. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available, and hit the like button so it's easier for others to find. Thank you, and we'll talk to you next week.